Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, an equity strategist for ADCB. With an objective to empower you with investment insights, on this program we discuss various perspectives shaping the global investment landscape. This week, we share our perspectives and views about the recent US Federal Open Market Committee meeting and its implications for financial markets. The US Federal Open Market Committee, FOMC, holds 8 regularly scheduled meetings during a calendar year where it discusses the current and future conduct of its monetary policy. For financial markets, these meetings have always been important to watch. Granted, some meetings are more important than others. The FOMC meeting held between January 25th and 26th was arguably very important given the recent hawkish turn of the central banks around the globe. In the press conference that followed FOMC meeting last week, Fed Chair Jerome Powell indicated that the committee kept its policy interest rate unchanged near zero and stated its expectations that an increase in this rate would soon be appropriate. The committee also agreed to continue reducing its net asset purchases on the schedule it announced in December, bringing them to an end in early March. Financial markets were volatile going into this Fed meeting and remained volatile after the press conference too. Chair Powell, declining to rule out raising interest rates at every policy meeting this year in order to combat inflation, was seen as a hawkish tilt. According to the CME Group data, futures market at the end of last week were pricing in a significant potential for at least 125 basis points of rate increases in 2022. Expectations for a 50 basis point hike in March meeting have remained high. Market also started to price in the prospects of balance sheet reduction by the US Fed. As a result, volatility increased with broader equity indices registering significant intraday volatility. Equity markets registered steep losses year to date while sovereign yield curves flip-flopped between bear steepening and bear flattening. Overall, markets seem to have been very aggressive in pricing in Fed rate hikes as they took the recent lack of dovishness for outright hawkishness. We beg to differ on this perspective. We've been of the view that the real risk to financial markets from the Fed comes when its policy turns inappropriate to the evolving growth inflation mix. This would account to a policy misstep in our view. In that context, recent FOMC statement and the press conference that followed helped alleviate some of our concerns. Yes, the Fed chair has not ruled out 7 rate rises this year, but equally he has not given out a clear indication that the committee is planning to raise interest rates so many times too. Instead, he emphasized the need to stay humble and nimble. Both words we liked very much. After all, we've been saying that even going into this phase of the cycle, which might not need very high levels of policy accommodation, uncertainty remains on several fronts. Therefore, it is important to remain humble regarding the outlook for growth and inflation, which could tilt one way or the other. In the words of Chair Powell, making appropriate monetary policy in this environment requires humility, recognizing that the economy evolves in unexpected ways. Also, given the fast-moving nature of this cycle, it is important to stay nimble. As we've been highlighting, global economy is moving fast into an asynchronous mid-cycle slowdown. One other word that caught our attention from the press conference was appropriate. Chair Powell used it 18 times during the prepared remarks as well as question-answer sessions that followed. To us, this was assuring enough that part of the Fed's conventional and unconventional policies will consider a wide range of information including readings on public health, labor market conditions, inflation pressures and inflation expectations, and financial and international developments. However, as we laid out in our outlook for 2022, we are working with a downside risk scenario under which a perceived policy misstep by central banks could cause market drawdowns. The key word here is perceived. But for as long as Fed remains humble and nimble and its policy remains appropriate to the evolution of the growth inflation mix, we think such drawdowns will remain viable. Of course, Fed being humble and nimble will also mean Fed will be data dependent. Therefore, volatility in economic data releases over the course of the next several months will influence market perceptions about the Fed policy path, and this will likely cause volatility in financial markets. This calls for staying invested in a well-diversified portfolio, something our regular listeners should be familiar with. In a nutshell, don't fight the Fed and stay course with your disciplined investment strategy. Thank you for listening to this podcast. We hope you found it useful. Please do share this with a friend or a colleague. In case you'd like to get more information on what was discussed on this podcast, please reach out to your contact at ADCB. You can also log on to our website www.adcbam.com for more information. You were listening to an episode of the Global Investment Insights podcast. My name is Kishore Muktinutalapati.